Welcome to the second lecture of derivative securities. My name is Kirby R. Cundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I'm currently working as a portfolio analyst and retirement strategist, and also as an adjunct professor of accounting and financial management. Today we will be covering Chapter 2 of the excellent text by John Hall, Option Futures and Other Derivatives, and we will be discussing futures markets and central counterparties. Futures contracts are traded on organized exchanges, and they are very standardized. They're available on a huge variety of assets, and they have very specific contracts associated with them. What can be delivered, where it can be delivered, and when it can be delivered. They are settled on a daily basis. By that we mean the marking to market process takes place on a daily basis, where money is moved from a short position to a long position or vice versa. The final settlement for delivery generally takes place on a particular day during each month. There are specific behaviors of futures contracts that will be discussed in more details later. One of the important things is how the futures price goes to the spot price. On the day of delivery, the two must be the same since the future becomes the spot, but sometimes the future price will tend to go down to the spot price, or the spot price will tend to come up to the futures price, meaning before the day of expiration, the future price is above spot. This behavior is called contango. The opposite, where before the day of delivery the spot price is above the futures price, is called backwardization. A very important feature of futures contracts is margins. Margin is cash or marginal securities that is deposited by an investor with his or her broker, and then these margins are marked to market on a daily basis, for example, at the Chicago Mercantile Exchange. So this daily settlement means that the loss is minimized that if a counterparty defaults, and in fact in the organized exchange futures, no one has ever lost money due to the default of a contract. So how do the margin cash flows work? Well, a trader has to bring the balance in the margin account up to the initial margin when it falls below a so-called maintenance margin. Remember, the exchange clearinghouse only has an initial margin that they put in initially, maybe $3,000, then they've got a maintenance margin, we'll say $2,000. If it drops below that, then they have to bring the money back up. And these daily margin cash flows are referred to as the variation margin. They are also required to contribute money to a so-called default fund. We'll go through the details of how this works with a mathematical example in a separate video that will be available after this lecture. Example of how a futures trade would work. Let's say an investor takes a long position in 2 December gold futures contracts on June 5th. So they engage in the transaction on June 5th, and the contracts would expire in December. They're going long, so they are agreeing to buy in December. The contract size is 100 ounces, so they are agreeing to buy 200 ounces of gold in December on June 5th. The futures price they sign the contract for is $1,250, so their initial margin requirement could be $6,000 per contract times 2 contracts are $12,000. If the maintenance margin is set at $4,500 per contract or $9,000 total, then they are okay and won't get a margin call as long as their amount of cash in their account stays above $9,000. But if it drops from $12,000 to $9,000, then they will get a margin call and they will have to deposit more money back in their margin account. This table shows how the cash flows take place. So we have margin cash flows when futures price increases. So if a future price increases, the short side loses money and the long side makes money. So the short trader would have to put money with his broker. The broker would put money with the clearinghouse. The clearinghouse would send the money to the broker for the long trader, and the long trader would get the money. The opposite would happen when the future price decreases. If the future price decreases, the short side makes money. So the long trader has to deposit money with their broker, which goes to the clearinghouse member, which goes to the clearinghouse, which then goes to the clearinghouse member of the short side, goes to the short side's broker, and eventually goes to the short trader. Terminology associated with futures contracts. There's the open interest, which is the total number of contracts outstanding. For a contract to be outstanding, there has to be both a long side and a short side. So this is equal to the number of long positions or the number of short positions. The settlement price is the price just before the final bell each day, and that's used for the daily marking to market or the daily settlement price. The volume of trading is how many of these contracts are traded in one day. So key points about futures, they are settled daily. This is unlike a forward contract. So the forward contracts were done over the counter. They are contracts between two parties. They are enforced in some extent through a regular legal system. They do not have, at least in the organized sense of the exchanges, margin accounts, and they are not settled on a daily basis. The way you close out a future is if you are long, then you buy a short. If you are short, you buy a long. And that again would be different than a forward, where you would have to actually get the counterparty to agree to close out the forward position. Most futures do not go to delivery. Most of the time they are used for a speculative or hedging mechanism. So most of the time if you buy a long futures contract on cattle, you don't actually intend to take delivery of the cattle at the delivery point, and you might just use this for the purpose of hedging against the cattle price, and then before the day of expiration you would close the future. That is, again, unlike forwards. In the case of forwards, most of them do go to expiration. Here is examples on crude oil trading on May 3rd of 2016. So this is trading on this date, and it's for futures that expire on these dates. So we have futures expiring on June of 2016, August 2016, December of 2016, December of 2017, and December of 2018. And we can see that the market believes the price of oil will increase from 45 up to 50 during this time period. This is the open price at the beginning of the day, the high for the day, the low for the day, the prior settlement the day before, and the last trade. Again, the last trade will be the trade that determines the marking to market process. Change from the trade the day before, the last trade the day before, and the volume. And of course, the volume is highest on the contract that's about to expire, and then gradually goes down and is actually quite low on contracts going several years out. So how are these contracts settled? How are they cleared? Well, bilateral clearing would be very common in the over-the-counter market, where you would just settle with your counterparty directly. Central clearing is done more now in the over-the-counter market than it used to be, and would of course be the normal standard in the futures market, where all clearing goes through a central clearing facility. So bilateral clearing, it's usually governed by the ISDA master agreement with a credit support annex, which is an agreement that has been added in the last few years that indicates what collateral would be forfeit if one party does not honor its contractual obligations. So the agreement explains the rights of one party if the other party defaults, and the CSA defines the collateral which must be posted. If one party defaults, the other party is entitled to keep any collateral that has been posted up to what is necessary to settle the claim. The CSAs have required variation margin in the past, but not initial margin. This caused problems, for example, the very interesting and large bankruptcy of long-term capital management that occurred in 1998, where a hedge fund had to be bailed out basically by the federal government, and that hedge fund had some very well-known people on it, including the Nobel Prize winners that developed the Black-Scholes asset pricing model that we will discuss later. So relatively new regulations for trades between financial institutions that are not cleared centrally now require the financial institutions to have CSAs with both an initial and a variation margin. So this is an effort to make forwards a bit more like futures and make them safer and less likely to cause default on one counterparty. And the initial margin that they are required to post is posted with a third party. How about delivery? Well, some contracts there is no delivery. For example, those on stock indices and Eurodollars are settled in cash, but those on commodities, delivery is a possibility. And if the contract isn't closed, that's going to take place. There has to be specifications on where it is going to be delivered, when it is going to be delivered, etc. And these vary a lot from, of course, contract to contract. Here is a list of future delivery locations for a small number of possible future contracts. For example, the natural gas futures contract can be delivered at the Henry Hub in Olathe, Louisiana in the southern United States. Gold can be delivered at New York, New York in the USA, or London in England. West Texas Intermediate crude oil can be delivered in a very small town in Oklahoma called Cushing in the United States. And the future contract that is signed will specify where the short must make delivery. And of course, due to things like localized supply and demand and transportation costs, the price of oil or the other commodities can vary by a decent amount depending on where delivery has to take place. Here is a graph of delivery options for cattle futures, and these are split up into various territories. For example, we show Colorado delivery territory, Iowa, Minnesota, South Dakota delivery territory, and Kansas delivery territory. So if you had a short futures contract in one of these territories, the short side would have some flexibility of which of these different locations they would have to actually deliver their physical cattle to. Now time for some basic understanding questions. When a new futures trade is completed, what are the possible effects on the open interest? Well, if both the short and the long are engaging in creating a new contract, the open interest would go up. If one side wants to get out of the contract and close out their position, while the other side is opening a new contract, then the open interest would stay the same. And if both counterparties, both the short and long, are interested in closing out the position, then the open interest would go down. So these three possibilities can occur. How about, can the volume of trading in a day be greater than the open interest? Absolutely, because people can initiate and close the same contract over and over again. So you could potentially have a relatively high volume and a low open interest. When trading in the futures market, the types of orders available to you are very similar to the types of orders available in the stock market. You can have a standard market order where the contract initiation, in this case either creating a long or a short, takes place as soon as you initiate it. You can have a limit order, in which case you will buy or sell only if you get a price that you like or better. You can have a stop loss order if you are trying to limit the losses if the market moves against you, and if the price drops are raises, depending on whether you're short or long, to a certain point that is negative for you, then that order would become a market order and initiate whenever possible. Or you can have a stop limit order, starts out like the stop loss order, but when the price moves against you, once it hits the negative price, you only initiate the order. Then after that, if it meets the limit price that you type in. You can have a market if touched order, where as soon as a price is hit, then that order also becomes a market order. The way these orders are executed can also be dependent on certain timing. You can have a discretionary order, which will tell the broker basically do it when you think it's best to do it. You can have a time of day order that only tries to execute at a certain time during the day if you think that matters as far as the price you will get. You can have an open order that could be open for up to 6 months. Generally, this would be combined with something like a limit order and will only be executed if you meet the price that you like. And you could also have a fill or kill order, which will either be filled almost immediately or the order is canceled. Futures markets are becoming more regulated, just like basically every other market. In the U.S., the regulation of the futures market is primarily the responsibility of the Commodity Futures and Trading Commission. And in theory, the regulations try to protect the public interest and prevent questionable trading practices, just like the regulations in the stock market that prevent things like front running. How about accounting and tax issues? Well, the way taxation is applied to futures is dependent on whether you are a hedger or a speculator. At least ideally, what they attempt to do is hedging profits and losses should be recognized at the same time as the losses and profits on the item being hedged. So if you are buying oil and you are using a long futures contract to hedge the oil price, you should recognize the profit or loss on the oil purchase at the same time as the profit or loss on your long position. Speculation, on the other hand, is an effort to make a profit by trading, and the losses from speculation are basically recognized on a market-to-market or a continuous basis. And this is at least what the U.S. tax code attempts to do when taxing futures, and we will look at some problems related to this issue later. Summary comparison of forward contracts and futures contracts. Again, forward contracts are private contracts between two parties created in the over-the-counter market. Futures are exchange traded and very standardized, whereas the forward contracts can be reasonably non-standard. Forwards generally have a specific delivery date and location. Futures can have a range of delivery dates. Generally, there is a future that expires every month. Forwards are settled at the end of the contract, whereas futures are market to market on a daily basis. For a forward, delivery or final cash settlement generally occurs. They generally go to expiration, whereas most of the time futures are closed out before the delivery date. Most people do not deliver the oil or the cattle in a futures contract. They merely use it as a speculative or hedging mechanism and then close it out before the day of expiration. Forwards do have some credit risk. It is possible for your counterparty to default. With the new rules, this is less likely, whereas futures basically have no credit risk. They're guaranteed by the exchanges, and both parties are required to put margins. In closing, we'll discuss foreign exchange quotes a little bit. Futures exchange rates are quoted as the number of US dollars per unit of the foreign currency. Forward exchange rates are quoted in the same way as spot exchange rates. So this means for some currencies, it is far more sensible, at least for those of us who are used to working in US dollars, than for others, For example, the Great British Pound, the Euro dollar, the Australian dollar, and the New Zealand dollar are quoted as US dollars per unit of the foreign currency, whereas other currencies, Canadian and Japan, are quoted as units of the foreign currency per US dollar, which is a little bit more confusing. If you've taken a physics class, you would know probably from your very first lessons that it's very important to put your units down, so you will know, for example, you're dealing in either miles per hour or kilometers per hour. The same thing applies to finance. It is very important to put down your units, whether it's going to be dollars per British pound or dollars per Canadian dollar or Canadian dollars per dollar, and you have to keep those straight. The textbooks don't always do a good job of this, but as a student, it's a very good idea to always make sure you write out your units. I thank you for watching this video.